2022 has risen a huge question. Why?
Raised the three key ECB interest rates.
El Banco de México, conocido como Banxico, aceleró la subida de tasas para contener la inflación.
Seventh hike in a row on Melbourne Cup Day.
The Federal Reserve raising interest rates by 0.75 percentage point.
Mucha atención, el Banco de la República acaba de subir las tasas de interés al nivel más alto de la historia reciente en el país.
The nation's central bank officially raising interest rates by 0.75%.
La Banca Centrale Europea ha alzato nuovamente i tassi di interesse di 75 punti base.
To carry on raising interest rates.
Aqui no Brasil, o Banco Central aumentou a Selic para 13,25% ao ano.
The Reserve Bank of India, India Central Bank, intervened. They hiked key lending rates once again. By how much? 50 basis points.
Why are interest rates so important? And why should we care? Everybody knows what are interest rates, kind of. But why are they so important, especially during this economic environment? In this episode of The Adventure of Finance, we will try to answer this question. So interest rates are basically the proportion of a loan that is charged as an interest to the borrower, usually expressed as an annual percentage of the loan outstanding, right? Everybody knows that. That's very complex. We can make it much more simple. So interest rates are simply the price of money. That's it. Interest rates are the price of money. So like an apple costs 50 cents to buy and you can sell it for 50 cents, for example, the same thing applies with interest rates. Interest rate is the price at which people are willing to sell their money, lend it, or they are willing to buy money. So that's why interest rates are so important. They are like the backbone of money. They are used to value everything in the financial industry, from stocks to bonds, time deposits, even currencies. So let's dive right into it. So how do we arrive to a certain interest rate? It's just a magical number that some guy decides? Not really. Interest rates, like the price of any good, are decided by the supply and demand of that particular good. So the supply of money, people that have extra money and want to lend it or invest it, and the demand of money, businesses, governments, and individuals that want to borrow money, will find an equilibrium price, an interest rate that will be shown in any financial outlet that you have. So how do we measure interest rates? As you can measure distance with kilometers or miles, or mass with pounds or kilograms, you can measure interest rates by the compounding frequency. Usually interest rates are compound interest rates, which basically means that you can get an interest on the interest you receive throughout the year. And simple interest rate is that you simply get an interest rate from the principal that you bought or sold. So there are different compounding frequencies. For example, usually bonds have a compounding frequency of 2. That means that you will have payments every 6 months or every semester. That's a semi-annual compounding. Credit cards usually have monthly compounding. So you will make payments every single month. So why are they so important? They're important because there's a difference between nominal interest rates and effective interest rates. When you see your credit card contract that you will be charged 26% interest rate annually, you're actually paying a higher interest because your compounding frequency is monthly. So as the compounding frequency gets higher, the actual money that you are paying or getting is higher. So for example, if the nominal interest rate in a time deposit says 5% paid semi-annually, the effective rate at which you will be having a return is actually 5.06%, because during the first semester you will get half of that 5%, so 2.5% interest rate on the principal, and then you will add that up to the balance, and at the end of the year you will have 2.5% on that interest rate plus the principal. So you will be getting at the end more money than the nominal interest rate implies. This is very important because you have to consider this in your credit card debt, in your mortgages, or in any instrument when you are trying to calculate the price of it. So there are different types of interest rates. You have discount rates, that are simply the interest rates on projects, stocks, bonds, or any financial instrument. You have the risk-free interest rate that is usually government issued instruments by the United States. So T-bonds, T-notes, T-bills, and you have AAA corporate bond interest rates. You also have mortgage rates, that's simply the price of money in the real estate market. So interest rates are embedded throughout the economy. They are very important and they are related to money everywhere. One thing we have to mention is that interest rates and risk are related. When I said risk-free rate, you usually see the lowest interest rate in these kind of instruments because they are deemed the safest, and discount rates for stocks and bonds because they are riskier than government issued instruments. They have a higher interest, a higher price, a higher premium for those that are selling money to this instrument. And that's where the value of interest rates arises. We have to talk about the discounted cash flow. It's a simple subject in finance that basically means that, for example, when you buy a bond, you are promised to receive interest and the payment of the principal at the end throughout, let's say, 5 years. Every single cash flow payment throughout those 5 years is not the same because they are made during different time periods. So you have to discount them, bring them back to the present with the discount rate, which is basically the minimum rate, the minimum price that you are willing to sell for your money, and then you add all of those values together and you get the price of a bond. It's not the same with stocks. The logic is the same, but the theoretical price is usually not the same as the market price because you have investor sentiment, you have what people perceive of the future prospect of a stock, but the logic is the same. And that's why there's an inverse relationship between interest rates and stocks and bonds. As interest rates go up, the discount rate is higher and the price of stocks and bonds gets lower. That's why we have seen throughout 2022 that investment portfolios, your retirement accounts, and any investment or financial instrument is getting lower in prices because interest rates throughout the world are getting higher. The Federal Reserve is hiking interest rates. The European Central Bank is hiking interest rates. The UK and most economies are doing this, not only because there is inflation, which will be a topic we will see in the next video. Comment down below what other finance topics would you like me to touch in the future, but also because as interest rates get higher in one particular country, for example the US, the value of US money gets higher and people are willing to sell US money, US dollars, more than they are willing to sell their own money. And because of this, we have seen currencies getting devalued in different countries, emerging economies and also advanced economies. And that's why interest rates are so important, not only because they value stocks and bonds, but because they are also used to value currencies throughout the world. So if you see the US getting higher interest rate hikes, then you will expect its currency to get more valuable and other currencies to get devalued, which is not a good thing when you have loans in US dollars because you will have to pay more local currency to get US dollars. Now they are more expensive. But not only that, interest rates are also super important because they are the fuel of the economy. As we have seen in 2020, most central banks have lowered interest rates to historical lows because they wanted the economy to keep fighting the pandemic and not get into a deep depression or recession. And that's why we have seen inflation, because as this fuel of the economy makes the economy grow and grow, usually the economy tends to get hot. And when it gets overheated, we see inflation. And now that we have seen inflation at historical highs, we have seen inflation rates that are very bad for the average individual, we have to cool the economy by raising interest rates. When we raise interest rates, more people are willing to sell money, invest, and not borrow to make the economy grow, to expand operations. So we see a slowdown in the economy. That's usually the case when considering economic and finance theory. So in conclusion, interest rates are super important. They're used to price everything because they are the price of money. They value stocks, bonds, any financial instrument. They are used to value currencies throughout the world. And also, they are the fuel of the economy. So that's why they are so important right now. And that's why you should care about interest rates. If you want to look at only 3 indicators throughout your whole life to know how the economy is going, just look at the interest rate, the inflation rate, and the exchange rate of your country. That's it. If you look right now at the interest rate and the pattern that it's having, you can have a broad idea of how the economy is going. So please remember to check once in a while the interest rate of your country to make better financial decisions and be prepared for any change in the current financial and economic environment. Thank you for watching. If you stayed up until this point and you want to know the 7 habits that changed my life in 7 minutes, click here to see my latest video. If you would like to see more videos about business, finance, and books, consider subscribing to the channel. I hope you found this video interesting and useful for your personal and financial life. Thank you again for watching the video, and I hope to see you all on the next one. Ciao, ciao.